Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back TBL Research Associate Johan Bergman. Johan, thanks for joining us again. Let's go right to the price. Bitcoin is trading at 117,400. We're recording this on Wednesday, October 1st. The block height is 917,221. Now, Johan, you gave us a great episode last week on your overall framework. Why don't we briefly revisit that, check in with where we are on the price, and then we can go into the deeper on-chain analysis for the day.
Yeah, that's great. So glad to be back, Nick. And yeah, it's a great day to go through the price action because we saw interesting price action. So yeah, last week I showed this overview, and I think it's worthwhile to point out that last week it wasn't clear which way price would go. We were in a downtrend, and we were discussing the possibility and maybe the probability that the price would go lower. But I want to point out this engulfing candle, and an engulfing candle means that you not only regain everything you lost, but also gain even more. So that could be in both ways. So we saw an engulfing candle to the downside here at the all-time high, and that really started this downtrend. So you've got this second candle, which is larger than the previous candle, and it's often a trend reversal sign. And yeah, we didn't had the price going down further, but I think at Sunday night and Monday morning, price really took off. And sometimes in the weekends, when price goes up, it mostly get faded away. Sometimes even during the weekend already, or sometimes the first thing in the morning, then price goes back to where it was, and the whole move up that fades away. But this time the momentum really hold, and I'm kicked in second gear basically. And yesterday we closed this candle nice, and yeah, this might be the trend reversal. Yeah.
Bullish engulfing and bearish engulfing candles are a big signal behaviorally. Johan prefers the 3-day time horizon. The engulfing nature, we have to think about it behaviorally. That's how I like to explain why technical analysis is important. Let's start with the red candle a few weeks ago. The bearish engulfing candle, what it means is we had a charge up, a large green candle, and then a red one that is even greater in range than the previous green candle. And it means, from the behavior standpoint, not only is this all-time high rejected, but we don't actually think that we even belong in this range. Not rejected and give up a little bit and we'll wait and see whether it's going to give, but actually a reversal trend. Now, the 3-day candle last week, or basically at the end of last week, at the beginning of this week, it reversed the price action that we had late last week, the bearish price action. That's what set us up for a bullish move into today. Okay, now take us to the high volume node around 117, 118 that you talked about last week, and what the price did when we got there. And you can relate it to longs and shorts and behaviorally where they entered the market and what they're thinking about now.
Yes, of course. So thank you, Nick, for clearing up what the behavior is behind the engulfing candles, because there was a perfect explanation. So if we look at the volume profile, we talked about this high volume node around 117 and this high volume node around 105, and we pointed out that the high volume node at 105 should act as support. But also when price were to go up, the high volume node at 117 may act as a resistance. And then I think the reason because like the reason because that may occur is because a lot of people here got in their positions at 118, hoping for price to run up even further, but price went down. Market sentiment was getting bad, and now we're getting up there again. And sometimes people who didn't have the conviction are taking this possibility for a sort of get out of jail free card, and also traders who entered their position at this lower at the lower point of the range, they also look at these volume profiles and they set like their targets at the next high volume node. So I think there are traders who are taking profits, and I think there are people who got scared when price dropped back and they're now getting out of their position again.
And it's excellent. This is why a high volume node serves as resistance, because when you get back to that level, the people that entered, they get out because it's that get out of jail free card as you described. Now, let's go behind the paywall. I like to say we just published our risk report mean median mode over at the bitcoinlayer.com/subscribe for TBL pros. We're going to let you guys take a look at some of these charts and analysis that Johan had on price, both on the on-chain side, but I believe you want to start with the derivatives market here.
Yes, please. So because I think this is a important thing, because sometimes if price runs up, we're not always sure what the exact reason was. Like, is there people getting levered long, and if that's the case, the chances are high that move up gets faded away because they might get liquidated out of their positions. So to be sure what we're dealing with, I like to take a look at the derivatives market, and this is basically only perpetual futures. They also call it swaps. And what we're seeing here is some healthy and not frothy at all market in the derivatives market, and we can see that on the aggregated funding rate. So these are all aggregated metrics, and aggregated means that it's taken they've taken data from multiple exchanges and weighted on open interest. So I think this is the most fair way to evaluate what's happening on different kind of exchanges. And what we're seeing here is that you don't want to see the open interest rise too fast, because if the open interest rises faster than the price rise, then that might be a sign that most of the gains of the price gains comes from levered longs or new long positions. So you don't want to see that. Mostly when we see that, then we also see the funding rate is going higher, because there are just more people wanting to go long than there's short. So to balance that imbalance out, the people who want to go long have to pay more, and they pay to the ones who want to short, because you always, every contract has a long position and a short position. So, but we don't see that either. Also a healthy thing we saw when we reached the all-time highs at 124 and there before in July, that the prices of Bitcoin for the swaps was higher than the spot price, and I made that red. So you can really see in one side that when there's a bit of trough in the market, and that's every time we've reached new highs, but this time is different, and this time we also see short liquidations instead of long liquidations. So here we saw a short squeeze, which made the price run up. and we're seeing that today again. So I think this is a very healthy basis to go higher. Yeah.
Now we have a little rise there in open interest for sure, but not really that spike in funding rates, and definitely no change in the delta between these two prices of the spot market and the derivatives market. So when let's just talk about funding rates for a second, because I know you are looking at open interest, but it's a balance of open interest with funding rates.
Correct.
Elevated funding rates are going to be that evidence that there's a lot of new longs coming, or not necessarily new, but a lot of longs coming in and wanting to take out leverage positions and having to pay up for those leverage positions. We can confirm it with an increase in open interest and the two that balance. So is there a level of funding rate, an absolute level or a relative level, or a type of change that really sounds the alarm and gets you on hyper alert that this rally will maybe exhibit a BART formation, something that we discussed a little bit last week?
Yeah. So that's a great question. Let's zoom out a bit. Then the eye can see. So I mean, we notice, like, it's sometimes it's obvious, and for people, let me check real quick, so that they understand what's happening, because these are 8-hour averages, and we have to multiply. So this is, we're seeing here now what the funding rate is at the moment. So, and that we have to do, that's for 8 hours. So we have to multiply it with 3 for 24 hours, and then 365. So now we're at 7% annualized. That's not a lot. So like within 5 and 10% on annualized rate, that's normal. But at these points in history, I don't. I think we're going up to 20-30% annualized rate. So, and that's where the market really gets frothy. And I mean, it doesn't mean that the open interest might just had a little bit of too much today, and we can see some. We always see, and that's a crazy thing. We sometimes see long liquidations when the price even moves up, because they're too hungry for leverage. They're too hungry for returns. But I think at this point, I think everyone can see those funding rates are quite low. I think it's looking healthy. Yeah.
And this next panel down below the funding rates is showing the difference between the spot price and the derivatives market price. So when your bars get red, it means that the derivatives price is actually outpacing the spot price. It's getting ahead of it, which is evidence of, I guess, leverage longs coming into the market that are outpacing the spot market, or where the market actually is across exchanges.
Yeah, 100%. That's correct, and that's a right way to think. And sometimes I realized this when I learned through time that it's not always the perpetual that gets more expensive. Sometimes spot is just selling off, and the perpetual price stays more steady. So then you get also this premium. So this, when that spot goes below the perp, and that's when just spot sells off. So it's not always the perpetual that there's more demand for like levered long, but sometimes it's just a weakness of spot buying. So, but both are not great. Yeah.
Now, show me, because this is a good one. Show me the last few examples of when this when the bars went red here. So you have one that's over the summer. And so
Yeah.
show the viewer what the price was doing, what led up to it, and what ended up happening on a couple examples so that they can get a feel for, yes, this is actually a danger sign.
Yeah, so perfect. So where we saw in the run up, I think this is a good example. So this was in 2024 after the ETFs were being launched. We saw just a lot of levered long, and this is also a thing. It could go on more or longer than one thinks, because if there's just a lot of demand, there's not the price not drawing back, because only when the price draws back, then people get exposed, like um, who's wearing pants and who isn't. So there was a good example, but basically you have to be wary when this happens. So when that when the perpetual price is higher than the spot price, you should be wary or just on alert. And same thing happened after the run up after Donald Trump got elected. Get this big run up from like 70K to 110 or 100K. We saw the same thing, and here the same thing again from 105 to new all-time highs, but not as severe as the other two. And I think this is a great segue also if we go to the Onchain, because basically in the Onchain metrics we see basically the same thing. So this is yeah, that would be great.
Okay, so I hate to do it, but I'm going to ask
Yeah,
yet another follow up here
of course.
on this differential, because it's important to think always about arbitrage in the market. So my question to you is, from a functional standpoint, you understand market mechanics and arbitrage really well and spread trades. Do the bars going red necessarily bring arbitrageurs to the market to capture that risk-free trade and basically keep a lid on price? Is that something that happens, or am I reading too much into it?
um I I'm more inclined to say that that may happen when funding rates increase, because then, yeah, then it's get more lucrative for people to be on the other side, on the short side, and then um, have a delta neutral position. So they buy spot Bitcoin, they sell the future, the perpetual future, and then they harvest that that higher funding rate. So I think that would be the sign of more short sellers coming in, or just like this delta neutral yield harvesting.
You guys know all about James Check at Check Onchain, and you know that he's one of our favorite analysts to go over what is going on in the Bitcoin market. And in Checkmate's opinion, the consolidation between $75,000 and $115,000 is evidence of a maturing market. Go to unchain.com/TBL to register for this event. On September 30th, James and the Unchained team will go through why ETFs are bringing more institutional allocation to Bitcoin, and why this current consolidation is evidence that the Bitcoin market is building strength underneath it. This session is designed to help you understand what this bull run means for Bitcoin. Register now for access to a new on-chain metrics report from Check Onchain at unchain.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archLending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. So let's go to the next on-chain chart then.
All right. So I want to show the net realized profit and loss, but I want to do it in comparison. We wrote about it in mean median modes a couple of times, but I just want to make sure that people understand the large amounts that we're talking about, but also the different regimes. So again, this is 2024 and 2025, and in purple we're seeing the long-term holder supply, and in orange we're seeing the short-term holder supply. And we're seeing here on a daily basis how much profit there is being taken by those holders. So after the run-up, after the ETF run-up, you see a lot of profit taking. Then during the consolidation, we're seeing less profit taking of long-term holders, and we see short-term holders taking losses even. And then after the run-up to 100 again, or to that was the first time of the $100,000, we're again seeing profit takings from both cohorts. Then we draw back with the tariff tantrum. We saw long-term holders. Long-term holders always take profit because their realized price is on average $37,000. So when they transact, there's always a profit. They almost never make losses, only during the depths of the bear market, when the market price even trading below the realized price of long-term holders. So that's very rare. So basically, when price trading at these prices, then long-term holders, if they transact, we see profit taking. And now we're more in this regime of where long-term holders are still taking some profits, and short-term holders are equal. And I think this chart shows one more thing about the size. People sometimes forget, because people are talking about, is there paper Bitcoin, but they need to understand that 22% of all Bitcoin is short-term holder supply. So in USD terms, that's $500 billion. $500 billion have been traded in the last 155 days, because 155 is the amount of days where the where basically the cutoff is between short-term holder and long-term holder supply. So these are massive numbers. And if we so this chart shows the cumulative profit taking, and with the 30-day change. And this is where when we were looking at the derivatives data, we saw these huge spikes after the run-up, after the ETF approvals, and after the presidential election, and now a bit, but lower. So, and this shows basically the exact same thing, and it's all human behavior. So it makes a lot of sense that it's equal, but it's also very fascinating for analysts like me. And I want to point out that like these are big numbers. These are big numbers. If we go to all, and this is also like the big signal, and the takeaway I wrote in mean median mode was that after the ETF run-up, people took, both cohorts together took almost $80 billion of profit. That's with a B, that's billion. And after the run-up, after the election, there's $100 billion profit taking. So, but the other side is when, like, people are losing patience. They ask, why is the price not rising? We have all this bullish news, but the last time the price did rise was when almost all profit taking was at zero. Like it's all like basically reset. That with a 30-day change, if you look back, there's no more profit taken, and here we at the same spot. So, and it makes so much sense, because the price can go up again if demand exceeds supply. So where there's no more supply coming online, when the profit taking really subsided, then there's room to have a run up again. And this time, we're not there yet, but it could be the case that even though there's still some selling, and this is looking 30 days back, so it could be the case that the selling now is already over. But this is such a clear example that for the price to rise, selling needs to stop, and then new demand is exceeding supply, and then price can rise.
It's a fascinating statistic. I actually haven't thought about the cumulative 30-day change overhang of these realized profits. It's almost counterintuitive to think about. And before I let you maybe try to rephrase it or summarize it for people, I want to talk about this idea that Bitcoin is being monetized. The bottom pane is actually showing you the quantity of dollars that come into existence via the Bitcoin network growth. Now, it doesn't mean that all these dollars are fresh credit dollars per se. That's a mix and there's no way to know. But for the seller of the Bitcoin, they are capturing the realized profit. And that is the physical process of Bitcoin monetization, where Bitcoin becomes money because somebody who held it for a long time has turned one Bitcoin from $5,000 to $100,000. And that $95,000 profit is the monetization process of Bitcoin. So, Johan, can you explain this visual, maybe with using the term overhang or resistance, and why these mountains on the bottom pane serve as an overhang? Because, like you said, until the cumulative 30-day look back net profit goes down to zero, until you get down to zero, you still have these sellers in the market.
Yes. So that's like what you said, that if price rises, there are people who bought lower, and that could be at $60,000, it could be at $80,000, but they have profits. They maybe sell a part of their stack, but they're ready. Like they've reached their level. Like everyone has like a number in his head. Everyone has a target, and maybe not for their entire stack, but just a little bit of Bitcoin that they're gonna sell because they want to buy a new car, or they want to pay down their debt on their home, or want to get married, have kids, buy a house. Like there are numerous of reasons why people are willing to sell their Bitcoin, even though they might know deep in their heart that Bitcoin might go up forever, or much higher. But at, like if not, you don't have unlimited time. So it's a balance about waiting for higher prices, but also living in the moment. So I think like Bitcoiners, I know Michael Saylor always telling people don't sell your Bitcoin, but Bitcoiners just sometimes sell to take a profit. And this bottom pane is just visualizing that. It's just visualizing people having unrealized profit. They bought at 30 or 60,000, price runs up to 90, they have got 50% gained, and they just they just sell some portion of their Bitcoin stack, and they just upgrade their life. And I think that's what we're seeing. And then people have to realize, because they're asking, but Johan, there's all these Bitcoin treasury companies and ETFs, and there's so much buying, and that's correct. But there wasn't enough buying power to have that $72 billion of overhang. There was not enough demand to push through and to get to higher highs. So then the market first needs to consolidate before everyone that got the number in their head. So I'm willing to sell my Bitcoin at $90,000 or $60,000. All that needs to get out of the system. People had enough time to sell their stack. And then when basically nobody wants to trade anymore, there's no incentives for people to transact. That's where the selling stops. And then if you got like a new catalyst, like the Fed cutting rates, or strong economy, or even within the Bitcoin space, it could be halving, could be ETF approval, it could be more Bitcoin treasury companies coming online, or I don't know which catalyst. There are plenty, and when the selling stops, then there's new catalyst. And then that's where demand kicks in and exceeds supply, and then the price rises.
Okay, now let's zoom into today. We've come off of a little mound of cumulative net profit, realized profit, I should say, as of late July, early August. Then the price did consolidate after that. So let's talk about right now.
Yeah, so right now we see right away some increase in realization of profit, and I think I should go back. I mean, this is much clearer. These are, I think, most recent numbers of today, and we're already seeing selling of $2 billion for the long-term holders and 500 million for short-term holders. I mean, that's 2.5 billion of Bitcoin sold to other people, and and there are some people who are a bit skeptical and said, yeah, but those Bitcoin could just be Bitcoin transferring from wallets, or somebody consolidating their UTXOs, and no, that could be the case. But on overall, I think it gives a clear message when people are just taking profits, or just transferring coins from their wallet to the exchange, or other way around. Yeah.
Well, and that's honestly a philosophical question about whether this on-chain data itself is relevant or not, because it's going to be noisy. We know, I mean, here's a basic example. The number of addresses in Bitcoin does not equal the number of users, but they are obviously correlated. And so there's edge cases for everything. But what do you say to that generally, in terms of, I find that there's signal in on-chain data versus people that say, how could you?
Yeah, I think it's like a law of the big numbers. I think it maybe for one person it's different, but for most people transacting on the Bitcoin blockchain, time chain, I think most of them are incentivized to sell, and I think that's the signal. You don't have to. Not everyone needs to be a seller to have to make this data correct. So it might not be 100% correct, but I think you have to think in direction. I think you have to think in probabilities, and I think it's very probable that that even like if we saw on that 30-day change, I think there's a lot of signal that's not on a daily, because sometimes like if an exchange shuffles wallets and stuff, and yeah, that could give spikes, and yes, that could be a bit noisy, but on average, I think there is a lot of signal in the on-chain data, and you can see just how it relates to the derivatives market, because funding rates funding rates are very close to SOPR, which is an on-chain metric, and implied volatility is very close to the sell-side risk ratio, those things we've written about before on the Bitcoin layer, and I think there's just truth in it, because you cannot make that up. It's a free market, and I think it's just human behavior.
Okay, I want to ask you about these on-chain metrics mirroring other markets such as the derivatives market or the options markets. Give us a little bit more texture to this. This is a concept we have discussed extensively with James Check from
Yes.
Check on Chain, who we're working closely with. This is so important for people to realize that what happens on the chain is behavior. What happens in the options market is behavior. What happens in the perp market is also behavior, and they mirror each other. Can you give us these specific examples of why SOPR is related to funding rates and why the sell side risk ratio is related to implied volatility? And both of those comparisons, the first one is an on-chain and the second one is another market metric. So give people a little bit deeper of an understanding so that they can have more confidence that the chain itself tells you behavior just as other markets do.
Yeah, of course. So SOPR and funding rates. Let's start there. SOPR is the spend output profit ratio, and what that means is it's a ratio of how much profit or loss there is taken within a day within like a certain cohort. Like a cohort, if you look at short-term holder and you look at the SOPR, you're looking at, all right, are short-term holders taking profits here or taking losses? And that SOPR shows the ratio of the net output of that day, and it almost it has the same pattern, and it's almost equal to the funding rate. So when funding rates are high, there are people who want to go long because they expect the price to go up more, and that's also where people are taking profit on chain. So that's why SOPR is mirroring and is showing the same patterns as the funding rates. And if we look at implied volatility, um, the implied volatility of the option market shows what the market is pricing in about what may come next. So that's why it's implied. It's basically saying how much volatility are we going to expect, and that's derived from the pricing of the option chain. And the sell side risk ratio is basically how much people are still transacting, and is comparing that to the realized cap. So you get this sell side risk ratio, a ratio to the realized cap, but it's also mirroring. You see that because people, what we've just talked about, after a while, people stop transacting because they don't have incentive anymore to transact, because maybe they had 6 months of time to sell their Bitcoin at $100,000. And that's what you also see at the implied volatility. It's like the market is saying, I think the volatility that we've seen will continue. And that's why the implied volatility and the sell side risk ratio shows the same pattern. And then if there's the catalyst, like the no one is selling, we've got this catalyst, the demand exceeding supply, price rises, and then people start thinking again, okay, I think the price will rise in the near future, and people are willing to pay higher prices for like a call option, and that makes the implied volatility goes higher. But because people transacting online, and the SOPR ratio is a ratio of the traded value as a ratio of the realized price, that because people transacting, the sell side risk ratio is rising. So they rise in tandem, and it's just behavior.
It's just behavior. That's what markets are, and that's what price does. It reacts to behavior. And so when we see Bitcoin's price go up, it brings sellers. That is the fundamental understanding that people have to come to this market with. It doesn't just go up forever in a straight line. It might go up forever in that we expect the compounding annual returns to be healthy, sizable, and avoid uh, a punishing string of down years. But that doesn't mean that it goes up in a straight line. Every time that it goes up, it will bring sellers, it will bring consolidations, and it might bring bear markets too. That's what we're on the lookout for. Johan Bergman, TBL Research Associate, thank you as always. Please tell people where they can find those great charts, because we got a few comments last time. Explain to them exactly where they need to go for that.
Yeah, thank you, Nick. People can find these on-chain metrics in this great open source project, and it's called Bitview.space. So Bitview.space. Yeah.
Bitview.space, and we'll link that as always. Thank you guys at home, and we'll catch you guys next time.
All right. Thank you, Nick.